Let's take a look at long-term investments. Now, first of all, we are talking primarily about long-term investments. However, this can also relate to shorter-term investments as well. So, what are the advantages of investing? Um, Typically, sales and other revenues come in sometimes at a very high rate, and then other times they're very low rate, and so they cycle up and down. And a lot of times the expenses, other than maybe cost of goods sold, tend to be more of a flattish sort of thing on a graph. So there's going to be times when we have lots more cash than what we need to pay the bills, and other times when there's not enough cash to pay the bills. And so we need, at those times when there's a lot more cash to pay the bills, if that cash is just sitting in a checking account, then we're not making any extra interest on that. It's just sitting there like dead weight. And we know from the time value of money techniques that we've studied in this semester that we're basically losing money. If we're not making money on it, we're losing it, because as time goes by, that money is going down in value. So but we need to invest it in things that typically, at least some of it, we need to invest in things that we can get out quickly for when we come to the time when our revenues are not enough to pay our bills. We need to quickly get some of that cash available. So at least some of the investments need to be readily available, shorter term investments, and anything we think we're not going to need for paying bills should go in longer term investments. The longer the term, the investment, typically the higher rate of return we're going to get. So whereas a checking account, we usually will get nothing, and then some shorter term bank things, we may get a few percent on, and then if we do something a little bit longer term in the stock or bond market, we'll get a little bit more. And if we get something even longer term, the longer term something is, generally it's a little more risky. And when something is a little more risky, it's going to generally come with a higher rate of return, but it also means you can lose money as well. So we have to invest wisely and have to know what we're doing. But every business generally has these kinds of cycles and needs to be able to invest those excess funds. So here on this slide, we're showing that they will invest the excess funds because they have the chance to earn a higher rate of return than a bank account, but still be able to get the funds when necessary to pay the bills, or if they wanted to save up for some, because they want to expand into different state or different country or something, get new equipment, they want to start putting money aside for that. We can secure certain operating or financing arrangements, such as here the example they give, Pepsi invests in a bottling company so that they can have some say in the bottling of their product. Now, they don't own the bottling company, but they have a pretty big chunk of ownership of the bottling company, enough that when they say something, the management of the bottling company is going to say, oh yeah, we need to do it that way. So they have some say, maybe not all the say, but they have a good amount of say so that they know that their Pepsi products, are going to be taken care of. And so they've invested a big chunk of money into the bottling company to be able to do that. So it's not just investing in stocks and bonds, but maybe investing in another company. Here are some of the types of investments that they might get into. There are two primary types of investments: equity securities and debt securities. Now, the equity securities means that you have some kind of equity in that company, and the debt securities means that 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 company owes you money. Okay, it's debt. It's debt for that company. They owe you back. Okay, so the equity securities tends to be stocks, and so we make money on the stock price going up over time. So if we pay $35 for a share of stock in General Motors and it goes up to $40, then we've made $5 during that time period without having done anything. Okay, so we can also lose money if the stock price goes down before we sell them. So at this point in time, with the virus pandemic going on, of course, the stock market has fallen. And so the price of every stock that you might have purchased 2 months ago has probably gone down. Now, typically the stock market goes up and down, and depending on what's happening in the business world or in the world of that particular industry or in the economy in general, whatever, affects the stock market, and it's going to go up and it's going to go down. And so you just have to hopefully have a good time frame that you're going to hold the stock so that you can make money on it. There are people who invest in stocks for a very short time and they sell them. If it goes up a penny, okay, they sell it. Okay, so but they do this for huge numbers of stocks and make some money that way. Debt securities is when we lend money to a different company and they are going to pay us back and they're going to pay us interest. Now, these are usually considered safer investments because there's an actual contract that says we promise to pay you back principal and the interest. Okay, if that company then declares bankruptcy, we can get screwed that way. But other than that, it's a fairly safe thing, unlike the stocks, which can go up and down and not be quite as safe. They're a little more risky, although we can make a lot more money on the stocks than we can on the bonds. The bonds are going to give us less. However, the interest will still be a lot more than what we can get from our bank account. So we may, instead of investing in stocks of General Motors, we may invest in bonds of General Motors, which means we're lending money to General Motors. And then they will pay us back in the 5 years or the 10 years, however long that bond is. And plus, they will give us interest every year in the meantime, oftentimes twice a year. Now, to value the investments as assets on our balance sheet, we need to know what type of security it is, and we need to know the intent of management. And then we can figure out how are we going to value that investment. So if we have a debt type of security and we don't plan on reselling that, because you can, if you invest in General Motors bonds, let's say a 10-year bond issue, and then 6 years from now, before you get to the maturity date of the 10 years, let's say you are ready to expand or buy new equipment and now you want your money back. Okay, so GM is not going to give you your money back early. It's set for 10 years. They'll give you your money back at the end of the maturity time at the 10 years. In the meantime, yes, they're giving you interest, but they're not going to give you your principal back early. However, other people in the market are willing to buy that GM bond from you because once they buy it, they say, well, it's only another 4 years and GM will be paying back this principal, plus I have a chance to get that interest. So you can sell that bond to somebody else. Now, can you sell it for exactly, what you paid for it? Well, no, you're not going to get your whole amount back, okay? They're taking it off your hands right now. They want to make an extra profit for doing that, these other people that are buying your GM bond. So, but if management has no plans when they purchase the bond in the first place, now their plans may change, but right now when they purchase the bond, they have no plan to sell it later, then we're going to value it at amortized cost. And this is the same way that we did in chapter 14 when we studied bonds. Okay, you have your discount, your amortized discount or premium as part of the general journal entries, all that kind of stuff. And as time goes by, you're going to put it into, take it out of that discount or premium and put it into interest revenue. However, many companies, when they're doing it as investments, as opposed to if you're GM and you're issuing the bonds, then you have to have that premium and discount account in there, those contra liability accounts. Okay, but if you're using it as an investment, oftentimes we don't use that. We just put it into the investment account. All right, what if you have a type of security as a bond, a debt security, but you do plan, management does plan on selling that before it gets mature? Well, then we're going to take a look at what is known as the fair value or fair market value. We're going to put it right on the balance sheet at what it's worth every year, as opposed to what we paid for it, plus or minus premiums and discounts. What if it's an equity security? Oops, sorry. Here, let me. What if it's an equity security? So if it's a stock, in other words, again, does management plan to sell it? Well, an equity security doesn't have a maturity date, until the company goes out of existence, that stock is good, but does management plan on selling it soon, selling it later? They bought it with the intention that they're going to sell it. Well, then again, we'll use the fair value, the fair market value approach. We'll see what that stock is worth every year. When we go to do our end of the year adjustments at the end of the fiscal year, we're going to see how much is that stock worth that day, and we're going to adjust it so the balance sheet shows that value. Finally, what if we have an equity and we actually have some control, like that example where Pepsi has some control over the bottling company that it invested in? Well, then we're going to use a valuation approach called the equity method, in which we are incorporating some of the assets, liabilities, revenues, expenses, etc., some of that is being incorporated into our own financial statements, into our own books. Okay, we're not going to talk a whole lot about that method. If you go on to a four-year college, you will have to take intermediate accounting over again, and they will talk about that equity method. Okay, so the amortized cost valuation, this is the carrying value of the bond or note. We calculate the present value of the principal due in the future. We usually have this all on an amortization schedule, just like we did in Chapter 14. And a subtraction is made of the discount, or an addition is made of the premium account. Now, once again, that account, we might have an account called premium and discount, or we might just shove the subtraction or the addition straight into the investment account itself. The fair market value is where we look up what is that bond or note worth that day. And we can find that in the Wall Street Journal. We can call a broker, whatever. So here's an example, $1,000 General Motors bond we paid $960 for, might resell for $940 today. Okay, so if we really needed our money back today, then we could go ahead and sell it to somebody else. That's called a secondary market. The primary market is where we got the bond in the first place, okay, straight from GM. A secondary market is where we're turning around and reselling that thing to just some stranger out in the market, okay? The books are changed so that the investment account will match the fair market value. So when we first purchase the bond, it's going to show at the carrying value, which is the $960. And when we go to sell, or a year later, if it's only worth $940, that's what's going to go on the balance sheet. We're not going to keep the $960 there like we do for most assets. Okay, it'll be what it is worth instead of what we paid for it. The difference between our book value, that carrying value that's on an amortization schedule or something, and the fair market value that we had to look up is called the unrealized holding gain or loss. So in the case of this GM example, we have an unrealized holding loss of $20, the difference between the $960 and the $940. If it was worth $970 today, instead of the $960 we paid for it, then we would have an unrealized holding gain of $10. The types of debt securities, we have what's called held to maturity, HTM, held to maturity. That means that management has the positive intention to hold these bonds until they mature. Now, they might change their mind sometime in the future. Something happens and they need to go ahead and sell those bonds in the secondary market to get some money. But their intention when they bought them was positively to we're just buying these 5-year bonds. We're going to wait for the 5 years and we're going to get our money back. And meantime, we're going to make this good interest rate, and this is what we're going to do. Okay? They must also be financially able to hold them, to be able to call them held to maturity. So in other words, if your company is kind of on the rocks, you're not financially doing good, then no one's going to believe that you're going to hold on to these bonds for the 5 or the 10 years or the 20 years, whatever it is. we're going to see that you're kind of shaky and you're going to need this money back, and you're not going to hold them to maturity. So you should not be putting them in the books on that amortized cost. You would be looking at fair market value and adjusting your balance sheet for that. All right, trading securities is when management has the intent to sell these in a very short time, usually in days, but definitely no more than a few months. Okay? You're trying to make a quick profit on short-term price changes. So most of the time, trading securities are where, okay, something's happening and this price is shooting up. I'm going to buy it now. I'm going to sell it in 3 days because it might come back down again. It might even out or whatever. I can see it shooting up right now. Or, as we talked about with the stock market game, prices can shoot down in the stock market as well. And you can do a sell short, in which case you're buying at a higher price, and then, you're selling at a higher price, but you're selling first, okay? And then you're buying it back or covering that sell short later on when the price went down. So your buy is low and your sell is high, okay? And so the trading securities also involves those kinds of things too. Now, typically, bonds don't have these, high movements up or down, typically. So usually you're not going to see that many bonds as part of a trading investment portfolio. However, you can, if there's something happening that can still affect a bond, and the price of the bond can go up or down, and so they can be used as trading. You just don't see them as often as stocks. Available for sale means anything in between. So we don't plan on holding this all the way to maturity, but we're not going to sell it in a short time. We are going to sell these maybe in 2 years or something. We're thinking that we're going to need to buy whole new equipment in 3 years. So in 3 years, we're just investing in these until 3 years from now, and then we'll sell all of these investments so that we got the money to buy the new equipment. Okay, and so in that case, it's not short term, but we're not holding it to maturity, and so we call those available for sale securities. Okay, when we take a look for accounting for the debt securities, if it's a held to maturity security, we're going to use that amortized cost method, and there is no unrealized holding gain or loss, okay, because we're just recording whatever we paid for that bond, plus or minus the premium or discount. That's what is on the books. And just because it's the end of the year and that bond is worth more or less, we're not adjusting it. We put it in there. The only thing that gets adjusted is any premium or discount. Okay. When we get interest, of course, we are recording interest revenue every time we receive it, and oftentimes with bonds, it's twice a year. So twice a year, we'd have a journal entry going into interest revenue. Now, what about trading securities? We're valuing those at fair market value. So we might have an unrealized holding gain or loss. And so we're going to take a look at what we paid for them. We're going to, whenever that was, maybe it was 2 years ago, and now at the end of this fiscal year, at the end of every fiscal year, we're going to see what is that worth. So if our fiscal year is January 1st to December 31st, we're going to look at the stock market, Wall Street Journal, whatever. We're going to find out what that is worth on December 31st. And if it's worth more than what we paid for it, that extra is an unrealized holding gain. If it's worth less than what we had originally paid for that security, then it's an unrealized holding loss. Okay? And that, because it's a trading security, even though we haven't sold it yet, we're going to sell it in the next couple days. And so that they go ahead and recognize that in net income right now on December 31st, even though we haven't sold it yet. We have talked repeatedly about how we don't record stuff, until the product is delivered, shipped, or until, if it's a service, we do the job. That's part of the matching principle. So we've drummed it into ourselves that we're never going to record something until, it's actually sold. However, this is one of the rare occasions when we do recognize that net income on the income statement. So if we had an unrealized holding gain, it would be shown as a real gain, even though we haven't sold it yet, for December 31st, for that year, not the year in which we actually sold it, but the year in which the value of that security was shown to exist. Now, of course, when we receive interest, we will record that just as usual. And we also have gains and losses from the sale of the security. What about available for sale securities? The fair market value is, again, the valuation that we're going to use for those. So that means we're going to look up the value on December 31st, compare it to what we had paid, okay, or compare it to last year's fair market value, either one, and see what the difference is. If we have more, if it's higher, then we'll have an unrealized holding gain. If it's lower, then we'll have an unrealized holding loss. Now here, we're not going to put it on the income statement though, because who knows how long it'll be before we sell this. So we don't want to recognize that change in value right on the income statement like we did with trading securities that we know we're going to sell them any day, okay? So instead, we're going to put them as other comprehensive income in the stockholders' equity section. So we know that when we close out revenues and expenses, it gets closed out into capital if it's a sole proprietor, and it gets closed out into retained earnings if it's a corporation. So those types of accounts, capital, retained earnings, those are equity accounts, okay? And so this is like a revenue or expense, but we don't want to put it on the income statement yet. So we're just going to kind of store this revenue or expense in this other comprehensive income account in the equity section. And it's kind of like we're just storing it there until we actually sell this. Okay, so we will record interest when we earn it, as usual, and we will record if we actually sell the bond to someone else, then however much we made or lost on the sale of that bond in the secondary market will go on there. Okay, so here is an example of a held-to-maturity security. Robinson Company purchased $100,000 of 8% bonds of Evermaster Corporation on January 1st of last year at a discount, paying $92,278. The bonds have a 5-year maturity and yield 10%. Interest is payable each July 1st and January 1st. So the investment is recorded at what we actually had to pay for it. We're going to debit debt investments and credit cash for the $92,278. And we need to make an amortization schedule. This is a held to maturity security. That means Robinson Company that purchased this investment is planning on holding it all the way to the end. This doesn't tell us how, 5-year maturity. So they're planning on holding it for the 5 years. Then they will get $100,000 paid back, redeemed from Evermaster Corporation at that time, 5 years from now. So we need to value this at the amortized cost, and so we need an amortization schedule. Now, just like we did for Chapter 14, the carrying value starts out with how much cash was paid or received, in this case paid, and it's going to go up, that carrying value is going to go up all the way till it hits the $100,000 mark 10 years from now or 5 years from now, and then that will get that $100,000 back. Now, the cash received for interest is $4,000. How did we get that $4,000? This was 8% bond, so that's the stated rate of interest. So 8% times 100,000 times, it's paid every 6 months, so 100,000 principal times 8% rate times the time of 6 months out of 12. Okay, and that would give us the $4,000. Okay, cash that we received on July 1st of the first year. Now, we have to calculate out interest revenue. That's done not by the principal, but by the previous carrying value times the interest, the market rate of interest. So we're going to take 92278 times the market interest, which was the yield 10%. Okay, and also it's every 6 months. So, So we're going to take the 92,278 times 10%, which would be 92,28. Then we're going to take that times 6/12 or half, and that equals the 4614. We compare the 4,000 to the 4614. It's a $614 difference. Okay, and so that's our discount is being amortized, $614. Now we know that our carrying value started out at 92,000, that we need to go on up slowly to 100,000. So that means we're going to be adding this amortized value each time so that we can slowly get up to 100,000. Okay, if we started out with a carrying value that was more than 100,000, then we'd have to go down to get to the 100,000. Then we would be subtracting this amortization. Okay, that would be if the bond had been a premium bond. Okay, so in this case, it's a discount bond. So 614 is added to the previous 92,278, and that brings us up to 92,892. This is now our new carrying value at the end of July. Okay. Now, on January 1st of year 2, We'll again get another $4,000. We'll take the previous balance, 92,892, times 10% times 6/12, okay? And that gives us our interest revenue that we're going to record on that day. The difference between those is the amortized discount. We add that to the previous carrying value to get the new carrying value, 93,537. Now, the thing is, if December 31st is the end of our fiscal year, then but we're not actually getting this interest till the next day on January 1st. Okay, on December 31st, we're going to have to do adjusting entries. And so we're going to show this interest revenue as having been earned on December 31st, because basically, it's 6 months worth of interest since July 1st. We earned it in this fiscal year, okay? Just because there's one day of the next fiscal year, okay? So we would have to show this in year one. So both of these interest revenues would be recorded in year one, okay? And both of these discount amortizations would be shown in year one, okay? So in July 1st, we're going to debit cash for the $4,000 of interest that we received, okay? And we're going to debit debt investments for 614. Remember, we had to add them to the carrying value, okay? And we're going to credit interest revenue for the whole 4614. This comes straight off the schedule under interest revenue column. Okay, now notice that for debt investments, I'm not doing a premium or a discount account, which is technically what this is. However, most companies for investments, they don't use the discount or premium account. They just shove it right into the investment account itself. Okay. Now, on December 31st, again, we're going to have an adjusting entry. Now, here I'm not debiting cash because I'm not actually receiving the cash until tomorrow. And so I'm going to debit interest receivable. This is a current asset because we're going to receive it shortly, okay, of $4,000. And we're going to debit or add to debt investments the 645. Now, if it had been a premium bond, we would have to subtract. We would be crediting debt investments for the 645 and the 614. And we're crediting interest revenue 4645. On the financial statements, we would show the interest revenue for the year of 9259. That's the 4614 and the 4645 that we pulled off that amortization schedule. And this would be shown as other revenue on the income statement, on our multiple step income statement. Okay, on the balance sheet, we would show interest receivable from December 31st of that $4,000 in the current asset section, and we would show the balance of the carrying value, which was 93,537 under the long-term investment section. So let's go back and see where we got that. Okay, so at the end of this period right here, where we had the 645 added to the 92,892, we got this 93,537. That is the carrying value for December 31st of year one. $93,537. Okay. Now let's take a look at trading securities. Remember, these are the securities that that management plans on selling quickly. And typically we're talking about days, no more than weeks, but it can be a little bit longer than that, but typically we're talking days. Okay? Normally we must sell something before we say that we earn the revenue. However, this is one of those times when we don't have to sell it. Since we're selling this and it's such an extremely short time, because the amount we'll receive for them won't significantly change over the next few days, the gains and losses can be shown on this period's income statement, even though we haven't quite sold it yet. The calculation for gains or losses is the amount received minus the book value, which is also means the carrying value, and that equals the gain or loss. Okay, so these gains and losses that are not quite sold yet are called unrealized gains or losses, or holding gains and losses. We use the fair market value instead of the amount received in the formula above. So this is our normal formula. When we sell something, we say, well, how much did we receive for selling it? And we subtract out our book value, and that's our gain and loss that we got on that thing. But now we haven't sold it yet. So instead of amount received, we're going to use that holding gain or holding loss amount, the fair market value amount, as our amount received. We're going to subtract out our carrying or book value, and that will give us our holding gain or loss, also called our unrealized gain or loss. Comes from that formula. Okay, I'm going to use the fair market value in place of the amount received. Okay, so here's an example. If we had Burlington Northern bonds and their amortized cost was $43,880, that means, the cost, the carrying value, the cost that we paid for them, plus and minus any discount or premium up to today. Okay, but then we looked with our broker on the Wall Street Journal, and we found out we could sell this in the secondary market for $51,500. Okay, so we have an unrealized gain of $76.40. General Motors bonds, amortized cost is $184,230. The fair market value we look up to sell them was $175,200. So we have a $9,030 unrealized loss on those. Time Warner bonds, $86,360 is our amortized cost on our amortization schedule. $91,500 is what they're worth. So we have an unrealized gain of $51.40, the difference between the fair market value and our amortized cost. So the total of our amortized cost for our whole portfolio is $314,450. The total of the fair market value is $318,200. The difference between those two is $37.50 unrealized gain. Okay, which I could also go down here, take Burlington Northern minus the General Motors loss plus the Time Warner's gain and get $37.50. Okay, if I had a fair market value adjustment from last year, I would have that here. So this is year one, so we don't have any previous year adjustment. And so our adjustment for year one is the $37.50. Okay, we need to make a journal entry on December 31st, the end of our fiscal year, showing the holding gain, even though we haven't sold these bonds yet. We're going to make a new account called the Fair Value Adjustment Account, which is an adjunct asset if it has a debit balance, or contra asset if it has a credit balance. It is attached to the investment accounts, in this case, the trading securities account. If we take the balance of the trading securities account and add this fair value adjustment balance, we will end up with the fair value. Okay, so 314,450. Okay, that was the total of the amortized cost. So that is the total that's sitting in the account called trading securities. Okay, then if we add this fair value adjustment account, that all we got in there are these fair value adjustments, up or down. These unrealized holding gains or losses are all piled into that account. Okay, so if I take my actual carrying value plus or minus the fair value adjustment account, okay, if it's a debit amount, it would be, we would add it. If it's a credit amount, we would subtract it. And that gives us this 314 plus the 3750 gives us 318,200, which is equal to the total of the fair market value on that day of December 31st. So the 314,450 is already on the books. So we just need to deal with this 3750 to put a journal entry in. So that's dated December 31st. Since it's an unrealized gain, that is something we're going to add to the value. Then we're going to debit the fair value adjustment account, which in this case is an adjunct asset. That means it's attached at the hip to another asset, but it has the same side balance. So assets are debit balances, and this has a debit balance. So that's called an adjunct account. And we're going to credit unrealized holding gain for $37.50. That is going on the income statement, since these are trading securities. Okay, we're going to show that as revenue, even though we haven't sold this yet. We're going to show that $37.50 as revenue. So on the income statement, we still have interest income of the $92.59. This is the same as we pulled off the amortization schedule, okay, that we use for held to maturity, okay. We would show the unrealized gain of $37.50 that we just put in, okay, would go on the income statement as revenue. Both of these would go in the other revenue section. The balance sheet, we would show the carrying value of the $314,450 in the trading securities account, which is in current assets. And we would also show that debit value of the fair value adjustment account of $37.50, which would be listed right below trading securities in the current asset section. The total of these two debit balances would equal $318,200, which is the fair market value. All right, let's turn to available for sale securities. For available for sale securities, management is planning on selling these before they mature, but they don't know when. They're not necessarily planning on selling them quickly, okay? So we can't put that holding gain or loss on the income statement because it could change a lot between December 31st and whenever we finally sell it. Who knows, it might be a year and a half from now. So we are not going to put the holding gain or loss on the income statement. We still will have a fair value adjustment account, just as we did with trading securities, because we are going to put this on the balance sheet at fair market value. But that holding gain or loss is, rather than going on as a revenue, and then into equity when we close out at the end of the year, it's going to go straight into equity without touching the revenue. At some point in the future, when we actually sell it, then we will put any gain or loss into a revenue or loss account. Okay, Okay, this allows the balance sheet to show the fair market value of the asset without showing the unrealized gain or loss on the income statement, because we're holding it in this like temporary account in the equity section. So here we have an example, Watson Corporation bonds and Anacomp bonds. Okay, here's their amortized costs, okay, and the total that's on the balance sheet as the carrying value. Here's the fair market value on December 31st that we looked up, and here's the total of that. Here's the unrealized gain or loss that we earned on each one, and in this case, we have an unrealized loss total, okay? We don't have any adjustment from last year, so for our first year, we have an unrealized loss of $95.37. Okay. We will not be putting the holding loss on the income statement, but in an equity account called unrealized holding gain or loss dash equity. So we have to have that word equity right in the account name. Okay. It will have it'll be a contra asset. That fair value adjustment account will be a contra asset since it will have a credit balance since we have a loss. So we're going to debit, just like a loss or an expense, we're going to debit unrealized holding gain or loss dash equity $95.37. If this were an unrealized gain, we would be crediting this unrealized holding gain or loss dash equity. But since it's a loss, we're debiting it. And we're crediting the fair value adjustment. This is a attachment to the available for sale securities. Okay. And we're crediting that because we need to subtract it because it's a loss. So this journal entry, if we had a gain, would be just the opposite. We would be debiting fair value adjustment and crediting unrealized holding gain or loss. On the income statement, we would show the interest revenue of the $92.59 comes straight off that amortization schedule. We would not show any unrealized gains or losses on the income statement. The balance sheet would show the available for sale securities, $293,537. That's the carrying value or amortized cost that we had on the schedule. And we would show the fair value adjustment credit balance of $95.37. So together, these two equals the $284,000. The $293,537 minus the holding loss of $95.37 equals $284,000, which equals the fair market value on December 31st. So our balance sheet is, in effect, showing the fair market value. There would be a reduction of stockholders' equity section of $95.37 as well, and it would be listed in the other comprehensive income section. Equity securities. So that was the end of the bond securities. For the equity securities, they represent ownership interests, usually through the purchases of stock, shares of stock, sold through a stock exchange. Because there's no maturity date, we just separate these into trading or available for sale. We only have two criteria. We don't have a held to maturity because there is no maturity date on stocks. The percentage of the total shares of stocks of the other company determines the amount of control we have over that company. We have several methods of accounting for these investments based on how much control we have. So if we only buy a few shares of GM stock, and there's millions of shares, then we have no control. It doesn't matter what we say to GM, they're not listening to us. Okay? Yeah, we're a part owner with our few measly shares. However, if we have enough shares that we have over 20% of the shares that exist, maybe less than 50%, we have significant control. What we say is going to have some impact on how GM does things. And so we would have to use the equity method, where we show our share of GM's net income in our books. If we have over 50% of the shares of stock that exist, then we have control. Even if every other shareholder lines up against us, we got 51% or better, whatever we vote. Remember, every share comes with one vote. So if we have 51% of the shares, we got 51% of the vote. Even if everybody else votes against us, we got control. Then in that case, it's called a subsidiary, and we have to consolidate our books with that company's books, even if it's not 100% subsidiary. These equity method and the consolidation method are methods beyond the scope of our class. You would learn those in a 4-year college. I just expect you to know that exists. Okay, so here we have some holdings that are less than 20% that are available for sale, and some holdings that are less than 20% that are trading securities. Both of those, we're going to use the fair value method. For available for sale, just like we talked about before, any holding gains or losses are going in other comprehensive section in equity. If it is a trading and we have less than 20%, then any holding gains or losses will be part of net income, go on the income statement. If we receive dividends, not all stocks pay dividends, but if we receive dividends, then whatever we receive, we would debit cash and credit dividend income, and that would go on the other income section of the income statement. And again, any of these, if we receive dividends, we would record them as dividend income. Okay? Here's an example. Here's some shares of stocks and what we actually paid for them. Okay, on the date of purchase, we debited equity investments for $718,550 and credited cash for $718,550. If we receive $4,200 in dividends, we debit cash, credit dividend revenue. At the end of the year, we take a look at the fair market value and the unrealized gains and losses. We total those up. In this case, we have unrealized loss of $35,550. Since it's a loss, we're going to debit unrealized holding gain or loss dash income for the trading ones of $35,550 and credit fair value adjustment trading $35,550. If this is an available for sale portfolio, we would debit unrealized holding gain or loss equity and credit fair value adjustment for available for sale securities. The income statement would show the dividend income. If it's trading securities, we would show the holding loss. If it's available for